In part 1, we showed you that real interest rates are the master variable for gold and Bitcoin. When real rates go negative, when inflation outpaces what bonds pay you, both assets historically surge. And we showed you that the bond market is under more pressure right now than at any point in decades. Today, we show you why that pressure is about to get a whole lot more intense, because the United States is moving toward a policy that would deliberately create negative real interest rates. Not by accident, by design. Welcome back to Bitcoin Capital Gold. This is part 2 of our 3-part bond series. Part 1 is the foundation. Watch that first if you haven't. Part 3 brings everything together with a clear positioning framework for gold and Bitcoin. Today, we're focused on what's coming, why it matters, and exactly what it means for both assets. Let's get into it. Something significant happened on January 30, 2026 that most investors completely misread. Trump nominated Kevin Warsh to replace Powell as Fed chair. Markets immediately read it as hawkish. Gold fell 18%, Bitcoin dropped over 25%. The narrative, hard money, higher rates, tighter policy. Markets got it wrong. Warsh's own words tell a different story. He called for a new Treasury Fed Accord, the language of coordination, not restriction. And Treasury Secretary Bessent has been even more explicit, repeatedly speaking about melding together the operations of the Fed and Treasury, already acting on it by shifting U.S. borrowing toward short-term bills to suppress long-term yields without officially calling it policy. Shadow yield curve control, already underway. The architecture is being assembled, the personnel are in place, and the destination has a name. Yield curve control. So what exactly is yield curve control and how is it different from what we've seen before? Most investors are familiar with quantitative easing, QE, which is when the Fed creates money to buy bonds and push yields lower. The key thing about QE is that it has a defined size. The Fed announces a program, say $80 billion a month in bond purchases, and the market knows there is a limit. Yield curve control is different in one critical way. Instead of targeting an amount of purchases, the Fed targets a yield level, a ceiling. It says the 10-year Treasury yield will not go above 3.5%, and then it buys whatever quantity of bonds is necessary to hold that ceiling. There is no limit. The market decides how much money the Fed has to print, because every time investors try to push yields above the cap, the Fed is forced to create more money to buy them down. Both QE and YCC result in liquidity flowing into the financial system, and both are bullish for hard assets. But YCC is open-ended. It is money printing on demand for as long as the ceiling needs to be defended. And in today's environment, with $39 trillion in U.S. debt and a government that cannot afford for long-term rates to rise freely, defending that ceiling could require an unprecedented expansion of the money supply. Now, here's a live development our viewers need to be watching right now because it connects directly to this story. Japan is widely expected to raise its benchmark interest rate to 1% in 2026. That may sound small, and in isolation it is, but Japan has been the world's great source of cheap money for decades. The yen carry trade, borrowing in cheap yen and investing in higher-yielding assets around the world, has funded a significant portion of global risk appetite for years. What's interesting about the timing is this. Japan's new prime minister recently visited Trump in Washington, and analysts are noting what looks like a coordinated signal. Japan appears to be waiting for a green light from the United States before moving. The suggestion is that a Japan rate hike and a U.S. shift toward YCC are part of a broader global monetary realignment happening simultaneously. For Bitcoin and gold investors, the Japan rate hike creates a short-term headache and a long-term opportunity, and it is important to understand both. Unlike previous BOJ moves that caught markets completely off guard and triggered sudden crypto sell-offs of 20 to 30%, this hike has been widely telegraphed. Markets have had time to prepare. The 1% move appears largely priced in, which should make the carry unwind more orderly than anything we saw in 2024 or 2025. But orderly does not mean painless. Bitcoin is still expected to test below $60,000 in the near term as yen carry positions are closed and risk assets are sold to repay cheap yen loans. The floor holds, but the short-term pressure is real. And here's the longer view once that unwind is complete. A world where Japan is raising rates while the U.S. is moving toward yield curve control is a world of sharply diverging monetary policy. Capital that no longer wants to sit in bonds in either country has to go somewhere. Historically, that kind of environment benefits gold significantly as investors seek stores of value outside the central bank system entirely. Short-term volatility, long-term opportunity. That is the Japan story for gold and Bitcoin investors. Now, let's go to the history, briefly, because one episode from the past tells us almost everything we need to know about what yield curve control does to gold. In the 1940s, the U.S. ran yield curve control to finance World War II. The Fed capped long-term rates at 2.5%. Inflation ran far above that, sometimes reaching 8, 10, or even 18%. Real interest rates were deeply, structurally negative for years. That is the environment that destroys the value of holding cash and bonds and sends capital into hard assets. There is one critical difference between then and now. From 1933 to 1974, private gold ownership was prohibited in the United States. Americans living through a decade of deeply negative real interest rates created by yield curve control had no legal way to buy gold. The escape route was closed. Today, it is wide open. And that changes everything about what yield curve control means for investors in 2026. Let's talk about what yield curve control means for gold, because this is where the thesis gets very specific. Yield curve control creates three direct tailwinds for gold, all operating at the same time. First, sharply negative real interest rates. By capping long-term yields while inflation persists, bond investors earn less than inflation. Every year, their purchasing power shrinks. Gold, which holds its value over centuries, becomes the rational alternative. Analysts are projecting that a sustained yield curve environment could accelerate gold toward $5,000 per ounce and beyond. Second, central bank purchasing. Central banks globally have been buying more than 1,000 metric tons of gold for 3 consecutive years. This is not speculative buying, it is strategic. Nations are reducing their dependence on U.S. treasuries as a reserve asset. If the U.S. implements yield curve control and the dollar weakens further as a result, that central bank buying accelerates. It provides a structural price floor under gold, regardless of what retail investors do. Third, flight to safety from a policy signal. When the U.S. government officially announces that it will cap bond yields, essentially admitting that free market interest rates are too high for the government to afford, that is a signal of fiscal distress. Gold has historically responded to that kind of sovereign credibility event with significant gains. A 15 to 30% move on the announcement alone would not be historically unusual. Gold, the primary beneficiary of yield curve control. In a yield curve environment, real interest rates go deeply negative by design. Cash loses purchasing power, bonds pay you less than inflation. Gold, the asset that pays nothing but holds value across centuries, becomes structurally more attractive with every passing month that yield curve control remains in place. The 1940s showed us what this environment looked like. The difference today is that investors can actually access it. Gold ETFs, gold mining stocks, and physical gold are all tools that did not exist for the ordinary American investor the last time this policy was run. Now let's bring Bitcoin into the yield curve picture, because this is where the analysis gets more nuanced. Yield curve control is bullish for Bitcoin, but through a different mechanism than gold, and with a very different risk profile along the way. The yield curve case for Bitcoin works through 4 channels. The first is the liquidity injection. When the Fed commits to buying unlimited bonds to hold its yield cap, it floods the financial system with newly created money. That liquidity has to go somewhere. In 2020, when the Fed ran large-scale bond purchases, Bitcoin surged from below $10,000 to nearly $30,000. Yield curve control is QE without a preset limit. The scale of money creation required to defend a U.S. yield cap in today's Treasury market could dwarf anything seen in 2020. The second is fiat debasement. Yield curve control is by its nature a signal that the government can no longer afford honest market interest rates. When that becomes official policy, confidence in the purchasing power of the dollar weakens. Bitcoin, with its fixed supply of exactly 21 million coins that no government can change, becomes a mathematically scarce alternative to a currency being deliberately diluted. The third is the opportunity cost collapse. When bond yields are capped at artificially low levels, the return on safe assets disappears. Investors holding cash or bonds earn nothing in real terms. That capital looks for higher upside. Bitcoin, as the highest beta scarce asset in the world, captures a significant portion of that rotation. The fourth is institutional adoption as the amplifier. By 2026, Bitcoin has established ETFs, growing corporate treasury adoption, and increasing sovereign interest. The infrastructure that was not there in previous cycles now exists. When the next wave of yield curve-driven liquidity enters the system, it has more institutional channels through which to flow into Bitcoin than ever before.
Bitcoin, high beta beneficiary, but the path is not straight. The long-term YCC thesis for Bitcoin is powerfully bullish, but the short-term path includes real volatility. Japan's rate hike puts pressure on Bitcoin near-term as the carry trade unwinds. When Warsh was announced as Fed chair and markets misread it as hawkish, Bitcoin dropped 25%. Short-term, Bitcoin behaves like a risk asset. It falls first and recovers later. Long-term, it benefits from exactly the same monetary debasement forces that drive gold. The difference is the magnitude of both the drawdowns and the recoveries. Bitcoin moves faster and further in both directions. That is not a flaw, it is a feature for investors who understand the time frame they are operating on. So let's bring Part 2 together and set up what Part 3 covers. The Fed is being rewired. Warsh takes the helm in May 2026. Besant at the Treasury is already suppressing long-term yields through issuance strategy. Both have spoken about a new Treasury-Fed accord. The destination is yield curve control, not yet officially, but the architecture is being built in plain sight. YCC is different from QE in one critical way. It is unlimited. The Fed prints whatever is needed to hold the yield cap. That creates an open-ended expansion of the money supply and deeply negative real interest rates by design. For gold, that is the most bullish macro environment in living memory. Negative real rates, central bank accumulation, and a flight to safety signal from sovereign fiscal stress. All three tailwinds operating at once. Analysts are targeting $5,000 per ounce and beyond. For Bitcoin, the path has more turbulence. Japan's well-telegraphed rate hike creates a near-term test towards $60,000 as carry positions unwind. But once that clears, the liquidity flood from U.S. YCC, combined with Bitcoin's fixed supply, institutional infrastructure, and role as a debasement hedge, sets up a powerful long-term recovery. Both assets benefit, but they play different roles, react at different speeds, and carry different risk profiles. In Part 1, we built the foundation, real rates, bond mechanics, the dollar story. In Part 2, we showed you the policy shift that is coming and why it changes the calculus for both gold and Bitcoin in 2026. Part 3 is where it becomes a portfolio decision. How do you hold gold and Bitcoin together in a world where yield curve control is either imminent or already here? When do you lean gold? When do you lean Bitcoin? And what does the bond market tell you when the balance shifts? Subscribe to Bitcoin Capital Gold and hit the notification bell. Part 3 drops shortly, and it is the video that ties this entire series together. If Part 2 gave you a clearer picture of where 2026 is heading, share it. Most investors won't understand what yield curve control means for their portfolio until it has already arrived. See you in Part 3.